Hello. I haven't done any recordings for Accounting 255 up to now. I've done a few for Accounting 202, so some of you may have seen some of those videos for Accounting 202. This week we have an assignment in 255 that I think students are finding somewhat challenging, and it is a pretty challenging problem. So let's take a look at it and let's see if we can figure out a good way to get started with this problem. So let me do a little bit of reading from the text. This is on page 83, P14, Statement of Cash Flows. And the Excel file template is called cash flow. So the learning objectives are to prepare a worksheet for the statement of cash flows, and that's basically what I want to get through, is using the information given in the text and this file template to complete this worksheet for statement of cash flows. We're using the indirect method. Now, for those of you who have already taken Accounting 201, you should know that we have two different methods for presenting the statement of cash flows. One is a direct method, which I personally prefer. When I teach Accounting 201, and this semester teaching Accounting 202, we're also covering a chapter on the statement of cash flows. Most of the assignments I assign are using the direct method. However, this problem assignment is using the indirect method. So basically the numbers that we come up with are pretty much the same. It's the approach that is different between the direct method and the indirect method. Interpret cash flow trends. We're not going to cover that, but that's part of this problem. And a couple other, we're going to create a chart, but we're not going to do this in this video. So let's take a look at the problem data. And again, this is in the textbook on page 83. For Prime Sports Gear Inc., they show comparative balance sheets. Now the balance sheet and selected income statement data are essential to being able to prepare a statement of cash flows. So they're giving us balance sheet data at the end of 2012 and also at the end of 2013. And that information is partially given on the template. On the template, what's shown is the amounts for December 31, 2012. You'll notice that the balance sheet totals in the textbook are different from the balance sheet totals on this template. And the reason they are different is because on this template they're taking the accumulated depreciation amount of $90,000, which is a credit amount, and instead of showing it up top with the assets as a reduction of the plant asset amount, they're showing it down below with the liabilities and equity as a credit. So of course we know that the proper presentation of a balance sheet requires that we show accumulated depreciation as a reduction of the plant asset amount up above under assets. So if we were to do that, if we were to take this $90,000 credit and reduce the asset total up above, then our asset total as well as our liability and equity total would be the same amounts as are reflected in the textbook, and that amount is $598,620. So basically we're working with the same information as in the text for 2012, 12/31/2012. We're setting it up in the format of a worksheet where we start with the 2012 balances. We have debit amounts and credit amounts to get to our 12/31/13 amounts or balances. And of course our check figures for these amounts over on the right side of the template of the worksheet are those amounts that are reflected in the textbook. Now down below is where it gets a little tricky, and down below the balance sheet is where we develop the information for our statement of cash flows. And from Accounting 201, and for those of you that are in Accounting 202, you should be aware of how our information is categorized on the statement of cash flows. Cash flows are essentially a summary of the debit totals and the credit totals to the cash account from the beginning of the year to the end of the year. So if we were to take our beginning cash at January 1 and add up all of our debits and subtract all of our credits, we would end up with our ending cash at 12/31. And that pretty much, makes sense. It's not rocket science, but it takes a little bit of time to develop the logic, I think, of how statement of cash flows works and how it's put together or constructed. What makes it a little tricky is that we categorize cash flows, and cash flows can be cash inflows, cash coming in, or debits. They can also be cash outflows or cash going out or credits. We categorize cash flows according to a different scheme, if you will. We categorize them based on whether they reflect operating activities, investing activities, or financing activities. And when I'm teaching cash flows in class, I try to help students get a grasp on how we categorize cash flows according to those three different types of activities by having them focus on the types of accounts that are involved in analyzing and coming up with those cash flows. And so our investing activities involve cash flows from our long-term assets. Our financing activities involve cash flows from our long-term liabilities and our equity accounts. And so that means our operating activities would come from transactions that involve our other accounts, which are our current assets and current liabilities, and also our income and expense accounts. So now, just listening to that in a video isn't the easiest way to visualize it and try to learn it, but hopefully you have some time to think about that a little bit, and hopefully it'll help. But anyway, let's see if we can get started in coming up with some of these amounts that we need to show on this cash flow worksheet. I think one of the first things we should do is create the formulas for our worksheet. And so if we the reason they have included the accumulated depreciation credit amount down below will become more apparent when we start looking at how we construct the formulas. So for debit accounts, we go from 12/31/12 to 12/31/13 by starting with our beginning balance and adding our debit amount and subtracting our credit amount. Again, if you take a look up top, we start with our beginning amount, we add our debit, subtract our credit to give us our ending amount. And so we should be able to use that formula, copy that formula down, all the way down So I was going to try and copy the formula all the way down, but the way these templates work is that they are asking the student for certain formulas, and then the spreadsheet is already set up to complete certain formulas like these two, which basically are dependent on information up above. So we have our three formulas up above for calculating these debit amounts. And for the credit amount formulas, it's similar, except we're starting with a credit amount. And so we will subtract the debit amount and add the credit amount. And that'll give us the desired balance. And as you can see, the amounts below filled in automatically because those formulas are already in there. But the spreadsheet is protected so as not to let students mess up those formulas or change those formulas. I shouldn't say mess up, I mean change those formulas. And the totals are already in there formula wise, and so we can start with that as a beginning point. Now, if we take a look at the additional data in the textbook, I think this is probably working with this additional data is probably the most challenging part of putting this cash flow worksheet together. And so we just take it one item at a time, just one item at a time. And so towards the bottom of page 83, additional data A, net income for 2013 was $121,610. And so it's important to note that when we prepare the statement of cash flows on the indirect method, we start out at the top under operating activities with net income. And so we should probably put that in at the top. And so our net income is 121,610, and our net income on the balance sheet becomes part of retained earnings through the closing process as a credit. So when we, as a just a quick refresher, when we close our books, if we are a corporation, and we can tell we're a corporation here because we have bonds and stock and retained earnings. So those are corporation accounts in the equity section. Well, bonds are a liability, a corporate liability. When we close our accounts for corporation, we close revenues with a debit and we credit retained earnings. Then we close expenses with a credit and we debit retained earnings. And the difference we credit and debit income summary. And then the third step of closing is to close income summary. And if our revenues exceed our expenses, that means we have a credit balance in income summary. And so to close income summary, we would debit income summary and credit retained earnings. And so on our worksheet, we show net income as a credit on the retained earnings line, and we also show it as a debit under the operating activities of our cash flow section of our worksheet. And again, debits essentially represent debits to cash. On the other hand, credits in our cash flow section represent credits to cash. So that takes care of A, and we should probably include the letter of the item given in the textbook. Okay, now the second item in the textbook at the bottom of page 83, item B, depreciation reported on the income statement for 2013 was 46.5. Now, we need to be able to basically recreate transactions in summary total based on the information given for each item. So the question we need to ask is, how is depreciation recorded? And depreciation is recorded as a debit to depreciation expense. So we need to add depreciation expense to our operating activity section of the statement of cash flows. And our depreciation, as you might know from studying the statement of cash flow, although this is indirect method, our depreciation is always added back to our net income amount as a non-cash expense. So basically what that's saying is that depreciation doesn't require an outlay of cash as an expense. It doesn't require an outlay of cash. And so if we start with our net income as the first addition to cash for the statement of cash flows, we would have to add back that non-cash expense, which represents depreciation. And so that becomes a debit in this statement of cash flow section under operating activities. And again, that amount was 46.5. And the offsetting credit is to accumulated depreciation, which is where depreciation, the account credit for used for recording depreciation expense. So again, as you can see, as we start out, for each item given, we need to have a debit or debits and a credit or credits, which represents the transaction that is being focused on and given to us in the text to analyze and record. And it needs to be in balance, just like any other transaction in any other accounting course. Okay, let's go over to page 84 to the top and take a look at item C. And as you might imagine, these are going to get a little bit more complicated as we move forward. Item C at the top of page 84, purchased $165,000 of new equipment. And how did we pay for it? We paid $90,000 cash, and we issued $75,000 of bonds. So we basically bought equipment, making a partial payment of cash, and the balance was paid for by issuing bonds to the seller. Do the bonds have any value to the seller? Well, they should. Those are our bonds. Bonds represent debt of the maker, which is us. And what is the value of a bond to the purchaser or the entity that acquires bonds? Well, bond will pay that entity or that individual interest over the lifetime of those bonds, and then at the end of the maturity period, at the maturity date, or at the end of the holding period for that for those bonds, they will be paid off. So at the end of the period of time that this entity holds those $75,000 of bonds, they will receive $75,000. And up to that point in time, they will receive regular interest payments on those bonds, since they are a debt of the maker, which is us as a corporation. Hopefully that makes sense. That's a little hard to follow when you're just listening to it from a talking head, but that's basically how it works. So let's go back and record that transaction. We purchased $165,000 of new equipment. So we find our equipment or plant asset account. This is item C, and it's $165,000. How did we pay for it? Now, if you recall, I said investing activities come about through the through transactions originating with long-term assets. And so long-term assets are what were purchased in this transaction. And so we would record that cash flow under investing activities, and we would probably call it purchase of plant assets. And that requires an outlay of cash, item C, and that was $90,000. Now, as far as the $75,000 payment through issuance of bonds, I think the best way to categorize that, and actually the correct way to categorize that, is to show it as a non-cash financing activity. And why is it classified as non-cash? Because the issuance of those bonds do not require or result in any cash flow, and so those would be properly categorized as a non-cash transaction, and we need a credit to balance off that entry. Notice at the bottom we need to maintain the debit total and the credit total after each transaction at the same amount. Debits always equal credits. Okay, let's see. Transaction D, old equipment originally costing $19,500, and that had been depreciated in the amount of $79.50, was sold for $8,000. So this transaction is basically a disposition of fixed asset type of transaction. We have the sale of partially depreciated equipment for cash. Okay, so let's see. Of course, we have cash inflow. That's the $8,000, and so we would show that under investing activities, sale of plant assets, and a cash inflow would be shown as a debit to cash. Let's see, that's item D, and that's $8,000. We also need to get rid of the asset amounts on our balance sheet, and so our plant asset, let's see, that's transaction D. Our plant asset cost was $19,500, so we would credit $19,500 to plant assets. And we need to get rid of the accumulated depreciation, and so we reduce accumulated depreciation with a debit, and that amount was $79.50. Now at this point we should begin to see some of the balances that we would like to see and need to have over on the right side of the balance sheet under December 31/13. And so if we take a look at some of those balances, we can see that our our plant asset account balance is correct, $460,500, and our accumulated depreciation balance is also correct. That's a credit of $128,550. Okay, so it's starting to happen. Let's see. So now we're on transaction E. Retired $60,000 of bonds. Now when we issue bonds, basically we are borrowing money. We sell bonds, we issue bonds, we sell bonds in exchange for cash. So, and that's essentially a loan type transaction. And bonds represent the issuer, in this case us. This is our promise to pay the bondholder interest during the period that the bondholder holds the bonds, and also a promise to pay the principal back at the maturity date of the bonds. So when we retire bonds, essentially we're paying them off. So if we retire $60,000 of bonds, that's going to represent a cash outflow, and since bonds are a long-term liability, that cash outflow is going to be shown under on our statement of cash flows under financing activities, and we can call that what it is, retirement of bonds. And since it is a cash outflow, that's going to be a credit of $60,000. The debit is going to be to our bond account on the a bond liability account on the balance sheet, and that's item E, since a debit reduces liability, and that's $60,000. Now, let's see. Yeah, that should work. We're still in balance here. No, we're not in balance. Why are we out of balance here? We are out of balance. We have 409,060 on the debit side and 412,610 on the credit side. We missed something here. Let's see. We're okay in A. We're okay in B. C, we had a debit of 165 and a credit of 90 and a credit of 75. Let's see in E. Let's see, take a look at D. In D, we had a credit of 19.5 and a debit of 79.50. Is that correct? I think I missed gain or loss on this sale of assets. Let's take a quick look. Our cost was 19.5 and our accumulated depreciation was 79.50, so our book value was 11,350. I'm sorry, 11,550, and we received 8,000 for it. So we hold on a sec. We had a loss of $3,550, and so that needs to be accounted for separately on the statement of cash flows under operating activities. And again, that would be treated loss on sale of plant assets. That is considered a non-cash loss. That was item D. And so added back to net income when we present our statement of cash flows under the direct method. And with that amount in there, we should be in balance, and we are. Okay, sorry about that. Forgot the loss on sale of plant assets. Whenever you sell a plant asset, you need to compare the net book value, which is the cost minus accumulated depreciation. You compare the net book value with the proceeds received for the sale, and the difference is either a gain if you receive more than net book value, or a loss, in our case a loss, if you receive less than net book value. So the net book value of those assets sold was 11,550, and the proceeds of the sale was 8,000, and so we ended up with a loss of 3,550. And again, that's like depreciation. That's treated as a non-cash expense, and so added back to net income under operating activities for statement of cash flow purposes. Okay. And then we did E, retirement of bonds. Let's see, F, declared cash dividends of $64,000. Now dividends is a equity account, and so we would show our cash dividend under financing activities, and we can probably call that declaration / payment of dividends. Payment of dividends is going to require a cash outflow, $64,000, and again, through the closing process, after we close income summary into retained earnings for a corporation, the last step of closing is to close the dividends account into retained earnings. Dividends are essentially paid out of retained earnings. Retained earnings represent accumulated earnings kept by the corporation, and so dividends represent a payment of those earnings to shareholders. And so we reduce retained earnings by the amount of dividends declared and paid. Let's see if our retained earnings balance is where we need it to be, and it is $229,510. So we're slowly getting to where we need to be, and I think we have one more additional data transaction to take a look at, and that's item G. Issued 1,500 shares of common stock at $27 per share. And so when we sell stock, that's going to be a financing activity, sale of common stock, and it's going to be a debit to cash, and that's calculated by taking the amount of shares issued times the price, 1,500 times 27, 40,500. So that's item G. And when we record the sale of stock, we debit cash for the selling price times the shares sold or issued. And we credit two accounts. We credit the stock account at par value, and our par value is shown there on the balance sheet, $20. So we would calculate that credit as 1,500 shares times $20 par, or $30,000, and the difference goes to the additional paid-in capital in excess of par. And so if the price was 27, par is 20, the additional paid-in capital amount is $7, and so 1,500 shares times $7 is $10,500. And let's see if our stock and paid-in capital accounts are what we want them to be. And in fact, they are. Okay, now one item that's a little, it's a concept that's a little difficult to understand, maybe, is when we show this non-cash classification on this transaction, we need to also show this up above in the respective account that is affected, and that account is bonds payable. Since we issued these bonds, we're showing them on our statement of cash flows as a non-cash transaction, but we also need to reflect that transaction C up above in the bonds payable account, since we issued $75,000 of bonds, and so that results in a balance of $120,000. And let's see if that agrees with the amount in the textbook under bonds for 2013, and it does. And so the offset to that credit up here to bonds payable is going to be a corresponding debit down below to our non-cash financing amount or category of issuance of bonds. Okay, let's see, where are we at? Now at this point we need to complete the rest of the information to move from our 12/31/12 balances to our 12/31/13 balances. And so we start with the next item under cash, after cash. And so we've used letters to correspond to our additional data, and I think maybe what we could do is use numbers for the other items. And so we can start with accounts receivable, and this is probably a little bit tricky too. Our accounts receivable, if we take a look at the balance sheet amounts in the textbook, started out at 112,215, ended up at 121,250. And so accounts receivable increased by $9,035. And so we need to show that on our balance sheet. Let's call that 1. And we need to, it being that account being a current asset account, the change is going to be reflected in our operating activities section of the statement of cash flows. Now this gets a little tricky. When a current asset increases, what is the effect on cash flow? What is the effect on cash? What is the cash flow? And so first of all, we need to make sure that our balance here is correct, 121,250, and it is. And so if accounts receivable goes up from the beginning of the year to the end of the year, that reflects uncollected sales. So that, you know, another way to say it is that we made sales but we haven't collected the cash. Therefore the effect of cash on cash as reflected on the statement of cash flows is negative. And so we would show that amount as a credit or a negative amount down below under operating activities. Next item is our merchandise inventory, and our merchandise inventory started out at 210,930 and ended up at 200,100. So our merchandise inventory decreased 10,830. So our merchandise inventory decreased by 10,830. Now the opposite is apparent when we look at current assets and whether our current asset account increased, which reflects a reduction in cash, or decreased, which reflects an increase in cash. The theory being that if a current asset like merchandise inventory decreased, that means we probably the reduction is probably resulting in an inflow of cash. We probably sold that merchandise. And so we would show that under operating activities. As a increase in cash, 10,830. Now these concepts are not the easiest to understand, but what it really requires you to do is to go back into either your Accounting 201 or Accounting 202 textbooks and review how statement of cash flows using the indirect method works. And I think if you did that, it would make more sense. Okay, next account is and again, as we move forward here, we need to make sure that our balances are correct. Prepaid expense account, let's see, that went from 10,875 to 11,400. 10,875 to 11,400, or an increase of 525. That was a debit of 525. And so just as with the accounts receivable, when we show an increase in a current asset account, that represents a decrease in cash. The example here would be that prepaid expense went up by $525, and to effect an increase in a prepaid expense requires an outlay of cash. So that would be a credit in the cash in the operating activity section of the cash flow statement. Let's see, are we done with the no, we're not done, but the last item we're going to look at is cash itself. So we'll come back to that. Accumulated depreciation is okay. Accounts payable, we need to look at accounts payable. Accounts payable went from 59,220 to 55,400. 59,220 to 55,400. So accounts payable went down by 38,20. Now, for a liability to go down requires a debit, and that debit is 3820. And so if a liability decreases from beginning of year to end of year, normally the decrease would be due to a payment of cash toward that liability. So that payment is reflected as a debit to the liability account and a credit in the operating activities section of the cash flow statement, and that is a decrease in accounts payable. And that was 3820. Okay. Let's see. Salaries payable. Salaries payable went from 30,000 to 54,000. That's an increase of 24,000. And so this is a little different from what happened in accounts payable. If salaries payable goes up, that requires a credit. And so normally we can look at that as an expense that is unpaid, therefore the effect on cash is positive. And so we would show that as a debit amount under operating activities in the statement of cash flows. Let's see. Have we covered all of our accounts? We have our cash is the last item we look at. So our accounts receivable is correct, 121,250. Merchandise inventory 200,100. Prepaid expenses 11,400. Plant assets 460,500. Accumulated depreciation 128,550. Accounts payable 55,400. Salaries payable 54,000. Bonds payable 120,000. Common stock 240. Additional paid in capital 33. And retained earnings 229,510. So all of our accounts are okay. So what we are reflecting at this point would be under operating activities, we would call that net cash inflows from operating activities, 193,110. Under investing activities, you see it's a negative amount, and so we would call that net cash outflows from investing activities, minus 82,000. And the last item would be under financing activities, also a negative amount, and so that would be called net cash outflows from financing activities, minus 83,500. And so I'm gonna just put a little bit of highlight here, if that's possible. Is that possible? Maybe not. Anyway, we have a positive cash flow amount from operating activities, negative cash flow amount from investing activities, negative cash flow amount from financing activities, and if we add the three totals together, our change in cash is a net positive amount of 27,610, and so that would be the last item shown on the balance sheet, and that would be, let's see, item number 6, I believe. 27,610. I wonder if we can use a formula. And is our cash balance correct? And it is 67,210. And so let's see, we're out of balance here. What did we forget? What did we forget? What did we forget? Oh, I know what we forgot. We forgot this 27,610. And so what we need to do is move it over into our credit balance to balance off our statement of cash flows 27,610, and now we're in balance. Okay, and that offsets the debit to the cash account up above. And I believe that pretty much completes that requirement for this problem under on page 83 and 84 through, let's see, this should, and through 85. This should be what you need to do for requirements 1, 2, and 3. Okay, so hopefully this helps. Not easy, challenging material. It really requires for you to review preparing a statement of cash flows using the indirect method from either your Accounting 201 or 202 textbooks. But hopefully this will make completion, at least for these requirements of this problem, easier. I will get this processed on YouTube, put out a link, and I'll send it out to everyone. In the meantime, keep sending me your questions and concerns, and I'll do my best to help you through them. I'm working on grading. I got a late start in grading. It's going to take a little bit of time going through each problem submission for all of you, for all those problems that are assigned. I've got more problems to post in assignments and in modules on La Lima, and so I'll start working on that as soon as I can. And I appreciate your continued hard work, and keep on trucking. Talk to you soon. Aloha.